all of you are staying healthy and safe. I am Gandharv Tongia, Executive Director and CFO at Polycab India Limited. On this call, we shall discuss the Q1 fiscal 24-25 results, which were approved in the board meeting held yesterday. We will be referring to the earnings presentation, condensed financial results and statements, which are available on the stock exchange's website, as well as on the investor relations page of our website. Joining me today from the management team, we have our Chairman and Managing Director, Mr. Inder Jaisinghani, and our Head Investor Relations, Mr. Chirayu Upadhyay. Let me now hand over the call to Inder Bhai for his comments.
Good afternoon, everyone. We are pleased to have commenced the year a strong note, achieving the highest ever first quarter revenue in the company history. Our operating margins too remain healthy, reflecting our ability to adapt and succeed in a dynamic market environment and the robust domestic economy, supported by structural reforms, focus on the infrastructure development, promising strong growth for our diverse product categories. As the demand landscape continue to show strength, we are fully prepared to capitalize on these significant opportunities and drive sustainable growth.
Thank you, Inder Bhai. India continues to be a bright spot on the global map, as is evident from the fact that most high-frequency indicators indicate that the domestic economy continues to remain resilient. Both manufacturing and services PMI rebounded after moderating in May 2024 from the high in March 2024, driven by a sharp rise in new orders. UPI transactions have shown a steady upward trend since their inception, continuing to remain near a record high in June 2024. While credit growth remains healthy at 15.6% year-on-year in June 2024. GST revenues stood at rupees 1.74 lakh crore, marking an 8% growth on a YOY basis and thus remained above the rupees 1 lakh crore mark for 28 consecutive months. Furthermore, the RBI has upgraded the FY25 GDP forecast to 7.2% from its earlier projection of 7%, indicating strong prospects for the domestic economy going forward. This growth was propelled by the ongoing strengthening of manufacturing activity, positive trends in the construction sector, and a gradual recovery in the rural segment. These factors are anticipated to enhance the prospects of household consumption in the future. However, infrastructure and construction growth slowed down in May 2024, mainly on account of lower government ordering activity due to elections in April-May 2024 and labor shortages. This was a temporary phenomenon and should reverse as government spending picks up in the coming months. With stability at the center, we anticipate policy continuity to drive the overall economic momentum further with a sustained focus on infrastructure, capital expenditure, and manufacturing, which will occupy center stage. Furthermore, the improved balance sheet positions for the corporate sector and financial sector, alongside a rise in capacity utilization to an 11-year high of 76.5% in March 2024, is providing support to the nascent recovery in private capital expenditure. Meanwhile, alongside structural policy initiatives such as reduced corporate tax rates, PLI schemes, and the global shift towards multipolarity, encouraging procurement diversity, we foresee these cyclical and structural shifts sustaining a positive cycle of increased investment. I would now hand over to Chirayu to take you through the financial performance for the quarter gone by.
Thank you, Gandharv. I would request everyone to refer to slide 4 of the earnings presentation. For the quarter ended 30th June 2024, our consolidated revenue grew by 21% year-on-year, driven by steady performance in the wires and cables business, ably supported by strong performance in the EPC and FMEG businesses. EBITDA grew by 6% year-on-year, with EBITDA margins at 12.4%. A notable decline in EBITDA margins was influenced by a shift in our business mix towards segments with lower margins. Specifically, the contribution from our higher margin international business declined from 8.9% in the same quarter last year to 5.3% in Q1 of fiscal year 2025, while debt from our lower margin EPC businesses increased from 3% last year to 10% in the current fiscal. The contribution increase from the EPC business was also accompanied by its own margin decline of 150 basis points year-on-year, which further added downward margin pressure. Additionally, domestically, our lower margin institutional business grew at a faster pace than our channel business, which further dampened margins. Our profit after tax stood at 4 billion, while with PAT margin at 8.5%. Overall finance cost stood at 413 million and other income at 584 million rupees. A detailed breakup of our other income and finance cost is provided on slide 17 of our earnings presentation. Net cash position improved from 16 to 16.3 billion rupees over 10.1 billion rupees in Q1 of the previous year, while working capital cycle at 64 days was higher than a comfortable range due to finished goods inventory buildup in the wires and cables business. The finished goods inventory buildup was due to sudden fall in demand towards the end of the quarter on account of the sharp decline in commodity prices. The inventory days are expected to normalize in the coming quarters. Moving on to slide 6. The wires and cable segment recorded a steady 11% year-on-year growth, with the domestic business registering a 15% year-on-year growth. The past quarter witnessed high volatility in commodity prices, with a sharp decline in the second half of the quarter impacting channel sales. As the commodity prices now seem stable and channel inventory at normalized levels, we expect an improvement in sales performance in the forthcoming quarters. Our optimism stems from the resilient demand environment in India, which continues to outpace many global counterparts, as highlighted in Gandharv's macro commentary. Looking ahead, we believe that the upcoming budget will proactively set the tone for economic development in the coming years, aiming for a Viksit Bharat by 2047, building upon the transformation witnessed over the last few years. The real estate sector too continues to maintain its impressive growth momentum as it stepped into 2024, with sales in H1 2024 scaling an 11-year high in terms of half-yearly sales. The sales volumes achieved in the first half of the year, despite the general elections being conducted in Q2 of this year, showcases the strong undercurrent of demand in the market. Project launches too are on a very strong footing. Calendar year 2023 had witnessed a 10-year high in terms of beginning of construction in new projects. The first 6 months of this calendar year has already surpassed 80% of the last year's number. All such projects will require wires over the course of next couple of years, aiding in accelerated industry growth. Meanwhile, our international business registered a 28% year-on-year decline, resulting into a contraction in its contribution to the company's top line. Further, elevated freight costs compressed the margins in the business. Overall, the shift in business mix from distribution to institutional sales, coupled with lower international business revenue, contributed to a reduction in margins in the wires and cable segment. Moving on to slide 8 for an update on the FMEG business. FMEG business recorded solid growth of 21% this quarter, driven by strong demand for fans due to heat wave across several parts of the country. The fan business achieved its highest quarterly sales in the past couple of years. Both the switches and switchgears and conduit pipes and fitting segments showed robust growth, supported by healthy demand in the real estate sector. Besides, our switches business continues to benefit from improved availability through in-house manufacturing, while the switchgear business continues to benefit or reap the benefit of our new product development initiatives. The lights and luminaires segment continues to face challenges due to pricing pressure and weak consumer demand. In terms of profitability, we've seen a decline in losses attributed to lower advertising costs and boosted by higher contribution from switchgears and conduit pipes and fittings product segments. At an annual level, our advertising and promotion spends will continue to be within a guided range of 3 to 5% of the B2C top line. Moving on to slide 10. This slide provides an update on our other businesses, which primarily comprises of our strategic EPC business. We achieved revenues of 4,815 million in Q1, marking a 292% year-on-year growth. Profitability increased by 244% year-on-year, while segmental margin registered a decline of 150 basis points to 11%. The robust growth within the business was driven by strong execution of the RDSS open book. Looking ahead, We expect this business to maintain its contribution in mid to high single-digit range to the company's consolidated top line. The annual sustainable operating margin for this business is expected to remain in the high single digits over the medium to long term. To conclude the financial update, the industry is experiencing robust demand environment, and Polycab is well positioned to capitalize on this favorable market dynamics. Looking ahead, we anticipate sustained demand momentum throughout the remainder of the year. As an update on our continuous efforts to improve on corporate governance practices, the board yesterday has reconstituted the audit and nomination and remuneration committees. Both these committees will now fully comprise of independent directors in line with globally accepted best governance practices. This change underscores our commitment to maintaining transparency, accountability, and integrity in our corporate governance framework. As in another positive update, India Ratings has improved on our outlook on our credit rating to positive from the initial on watch with negative implications. So that was an update for the quarter. Thank you, and we are now open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Shah from PL India. Please go ahead.
Yeah, hi. Thank you for taking my question. So the first question is related to the domestic wire and cable business, where if I look at around 16% of the value growth you had reported, can you give some color on how much is the volume number? Because raw material or copper aluminum prices also elevated for a quarter quite significantly. So that is the first question. And the second question, sir, on the international business. So as international business down by 28%, and in the last call also you had mentioned about the 3 to 5 quarters it is going to be impacted. So the current quarterly run rate to be maintained in the rest of the year, how to look at? And also earlier quarter you had given a guidance of a 10% contribution by 26. So is that intact or no?
Sure. Thanks, Praveen. On your first question, as far as the volume growth is concerned, the domestic wires and cables business registered a volume growth of about 10-odd%. While the value growth in terms of because of the increased commodity prices was there, but to a large extent it was a negative because of the effect it had on sales and largely on the channel sales. So that is where the volume growth was, and one needs to take into account that this is on a very high base of previous year. So that is where we believe that the wires and cables business has done reasonably well in this quarter. On your international business related question, one needs to look at an yearly run rate. So as against the domestic business wherein we supply our products or are able to supply within 24 hours or a matter of few days, an international business has a transit time within that. And as a result, the numbers that one has in a particular quarter is largely at the end of the quarter number. But there might be some revenue accruals which might be delayed and will come in the second quarter. So that is where one needs to look at an yearly number as far as the international business is concerned. But having said that, yes, we've guided that there is a bit of demand softness in one of our largest geographies. That is where the international business numbers are a bit softer as compared to previous year. But we believe that this will improve gradually going ahead. As far as the contribution to the overall top line is concerned, we will continue to work on on what we have guided. That is, we would want the international business to continue to contribute 10% of the company's top line.
Okay. And lastly, if you can give any guidance related to the LEAP project for 200 billion revenue for 26. So is that going to be a preponed, or how is the target going to change?
So Praveen, as you are quite aware, we have this target of reaching 20,000 crores of top line by FY26. We exited the previous year at a top line of about 18,000 crores, and that is where we believe that we should be either able to achieve or beat the guidance ahead of its time. As again we've guided in our previous calls, we are in the process of calibrating our new midterm guidance, and we will be releasing the new guidance during the course of this financial year.
Okay. Thank you and all the best.
Thanks, sir.
Thank you. The next question is from the line of Umang Mehta from Kotak Securities. Please go ahead.
Hi, thanks for the opportunity. My question is primarily on mix. Would it be possible to share the margin differential between your international and domestic, and even between domestic distribution and institutional? The context is that somehow 200 to 50 basis points contraction in wires and cables seems that there's some other element at play as well. Possible to elaborate on this?
So Umang, on our domestic business, generally we make EBITDA margins of somewhere between 9% to 11%, and on our international business, the margin profile is a bit better. But this is what plays out in a normal scenario. The last quarter was a bit off, where the commodity prices were quite volatile. This has a material impact as far as your channel sales are concerned, but not as much on the institutional sales, wherein we have back-to-back pricing. Right, so the margin profile for the past quarter will be a bit different than what we normally have. But again, as we've commented, this is something that we believe should normalize as the commodity prices now seem stable, and even the inventory levels in the channel have normalized. So going ahead, we believe we should be able to resume back to our margin profile. Even now, we are at the higher end or even at a bit higher than our guided range within the wires and cables business, and we should be able to improve upon that in the quarters to come.
Understood. So just one clarification. So 11 to 13% is your guidance in wires and cables, but last year I understand we benefited a lot from higher capacity utilization. But it would be safe to assume that given commodities are stable, you'll be doing better than your top end in the coming quarters. Would that be fair to say?
See, our guided range on cables and wires for the long term is 11 to 13%, but we've also said that because we are, as of now, realizing better operating leverage, we should be able to generate somewhere between 12 to 14% at EBITDA level. And that is where even now our EBITDA margins are in the first quarter. So we believe that this level of margins should be able to continue as well as improve upon as the entire issue with channel sales which happened in the first quarter moves away if the commodity prices continue to remain stable.
Okay, sure. This is helpful. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, I have a couple of questions on wires and cables. Firstly, your comment and your peers too, you said that there was a very sharp inventory destocking by the channel in June. So while I understand this reasoning, there was also a very sharp rise in copper prices from mid-March onwards till May end. So going by that logic, channel must have even restocked inventory at a very rate. So ultimately, this should actually negate that and not further depress the margin. So, sir, can you please comment on this phenomena, that how does it play out?
So, Natasha, your understanding is quite correct. In the first couple of months, the offtake was very good because the copper prices were on the rise, and that is where industry had or the channel had stocked up on inventory. June saw very sharp decline in commodity prices, and that is where the channel they kind of went slow as far as new orders were concerned, and utilized the inventory that they had stocked up in the first couple of months. So that is why we believe that now at the channel level, the inventories are at a normalized level. If the commodity prices will continue to be at stable as we've seen over the past few days, then hopefully that should mean that there should be an improvement in sales as well as margins going ahead.
Understood, Chirayu. My second question is on the international business. While that, registered a degrowth, So all this while we've been saying that, we're moving to a distribution-based model in the US, and now a new commentary is that there is a demand slowdown in that market. So just trying to understand, is it one-off, election-based, or the dynamics are changing fundamentally there? Because if that is the case, then are we going to further lose out on order booking in the international market? Is there a preference for other players or other global players and not Indian players? So a little bit, if you can touch on how US market is panning out in terms of cables.
So Natasha, there has been no material change as far as any preference for a particular country players are concerned. We don't believe there is any such sentiment that the country is preferring players from other countries. Largely, the demand slowdown or slowdown in the sales that we realize is because of the movement in our business model over there. Of course, we've guided that we'll take some more quarters for the new model to stabilize. So once hopefully that is done, the sales from that geography should recover back to its normal levels.
So Chirayu, can we expect that the impact from moving to a distribution-led model is greater in terms of numbers getting depressed and lower in terms of really demand not picking up in the US?
To a certain extent, yes. That is what we can say.
Okay, and just one last question, if I may. So you also mentioned that domestically the institutional business outpaced the distribution. First of all, can you explain if, is the company taking more orders directly and therefore there is more of institutional booking than GT? Because if that's the case, we could probably see more sales and margin moderation, because distributors are of the opinion that they prefer Polycab because they are not bypassed in the value chain. So just thinking out loud, if you can help, why exactly institutional outpaced the GT this time? That's all. Thank you.
So Natasha, as I mentioned, in institutional orders, we have back-to-back pricing, so they don't get largely affected because of this volatility in commodity prices, and that is where the orders that we had taken in the past 3 or 6 months and where we had to supply cables, those are something that we continue to supply. Whereas distributors, they take a view on where the copper prices are headed. Generally, the volatility in commodity prices or copper prices in a month is only about 4 to 5%. But last quarter, the volatility was quite high. From mid-March to mid-April, it went up by almost 15%. Mid-April to mid-June by almost mid-May to almost about 11%, and from mid-May to mid-June went down by almost 12%. So the volatility was quite high, and that is where the distributors, they obviously would not want to miss out on the lower prices that might be available to them in the next month. And that is where there was a slowdown as far as channel sales are concerned. So largely because of this, the mix or the growth rate for institutional was higher than the channel.
Understood, Chirayu. Thank you so much. That was helpful, and all the best.
Thanks, Natasha.
Thank you. The next question is from the line of Rahul Agarwal from Ikigai Asset Management. Please go ahead.
Thank you for the opportunity. So, 2 questions. Firstly, on the operating cash flow for the quarter, looks like the cash profit is about 450 crore plus, but the operating cash flow is negative 200 crores. I think partially Chirayu explained about inventory being higher, but the swing appears to be larger than that. Could you please explain this number, please?
Your observation is right. As Chirayu mentioned a while back, because of significant volatility in copper prices, in the month of June, we witnessed a slowdown in demand, particularly from the channel. We had a very robust run in the last fiscal, and in anticipation, we had a slightly higher than actual required inventory at RM level as well as at finished goods level. So that is the reason why the working capital has stretched a bit. And second reason, which we mentioned a while back, is the uptick in EPC business and institutional business. As you know, both of these businesses are not on channel financing, and which has some impact on our receivable days. So by and large, the cash flow which you are reading got impacted because of the change in the mix and higher inventory, which we believe is transitory in nature, and in the quarters to come, we should be able to normalize and go back to regular working capital cycle of 50 or 55 days or thereabout.
Got it. Fair point. Secondly, on the balance sheet, I'm referring to the March balance sheet. There is some long-term receivables shown about 120 crores, which are overdue 12 months. Just wanted to know the nature of this, the nature of this line item, please.
Yeah, sure. Your observation is right. As Chirayu mentioned, we have a small EPC business. In general, if you were to reflect on the last year, June, it was almost 3% of our top line. This year, it is 10% of top line. In EPC business, there are some balances which are retained by the customer as retention money, which ranges between 5 to 15% depending on the contract, customer and contractual terms. And these, as per the accounting standards, are required to be classified as long-term receivable. That 120 crore rupees is comprising of such balances.
All right. So no risk of when does it get liquidated? Broadly like 15 months or 18 months. What is the timeline here?
So it ranges between 12 months to 24 months from the end of the contract. Any which way, as part of the accounting requirements, we are required to carry provisions in the books for all types of receivables, including short-term and long-term receivables. So that provision in any which way is done, which is called expected credit loss provisioning.
Perfect, got it. And just one feedback, not a question. If Inderbai is on the call, been waiting for Polycab, analyst meet to be done from the company side, wherein we could spend some time with the SBU heads as well as the next generation of the promoter family, Nikhil and Bharat. If you would appreciate that, this might be helpful to understand what are their thoughts in terms of building this business ahead. So if that is possible and practical, I would request the company to essentially consider this, whenever convenient. Thank you so much.
I think that's great feedback. Thanks a lot for using this forum to share this feedback with us. As Chirayu mentioned, that during the course of the current year, we will probably recalibrate the expression guidance. And I think it would make sense to have such interactions once we have the revised guidance in place. So allow us some time, and hopefully in the current fiscal, we should be able to do both the things.
Appreciate that, Gandhar. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Sandhya from Unicorn Asset Management. Please go ahead.
Hi, Sanitya here. My first question is on the part of the margins in the EPC business. So, as observed, the margins in the EPC segment has been quite volatile, ranging from somewhere 12, positive of 12, north of 12 to currently at 11% stage, and sometime back it was less than 10, that is in single digit. So how do the margins in the EPC business look to us going ahead, and what kind of revenue share it could be in the total revenue?
Sure. So as far as the EPC business is concerned, this is a very strategic business for us, wherein we go in and bidding for such a project where there is a good or large element of cable. So it has not been an area of focus. As and when, in whatever quarter we come across such a project where there is a good cable supply, we go in and bid for this project, and that is where the margin profile as well for that segment has varied. Going ahead, we have a pretty good order book, and that's largely because of the RDSS scheme of the government. We've always guided that within the EPC business, the margin profile in the long term will be in high single digits. And that is something that will continue to guide the market. As far as its contribution to the company's top line is concerned, we believe that the contribution will range somewhere between mid to high single digits going ahead.
So currently you were saying it is around 10%, right?
Right. In first quarter of this financial year, it is at a higher level at 10%, but that's largely because the normal business, the cables and wires business, is registered a bit lower growth as compared to what we generally do. But going ahead, on a consistent basis, if you take an yearly view, the contribution from the EPC business will range in mid to high single digits.
Okay, so you're just seeing a higher contribution in the top line from the other segments rather than the EPC for the year going ahead. That would directly or indirectly help us in margin, EBITDA margins as well.
That's right.
Okay, thank you. And secondly, on inventory days and inventory turnover, so we are seeing quite a volatile nature there. In recent last 3 years as well, our inventory days have been continuously increasing. So is it due to the EPC business or it is on the retail side, distribution basically?
Again, over here, you'll have to take a more and a yearly view rather than a quarterly view, because depending on the business circumstances in every quarter, the inventory days will vary. But in general, what we have been able to achieve over the past 4 to 5 years is that the inventory days have come down. If you look at the inventory levels that we used to maintain while we got listed 5 years back, they used to be as high as 130, 140 days. But since last year, we are now generally averaging somewhere between 100 to 110 days of inventory. We believe this is a more optimized level of inventory. We've been able to optimize on that because of the advanced channel supply chain that we've been able to implement within our system in the country. Depending on what quarter you are looking at, it might be high. The past quarter, as I've already informed in my initial remarks, the inventory levels were high because of higher levels of finished goods that we had on our books because of the kind of demand that we were expecting in June. But again, what we've guided is that this is transitory in nature, and this inventory levels will moderate going ahead in the quarters to come. So generally, at a working capital day view, we believe 40 to 55 days of inventory or of working capital days is what is an optimum working capital cycle for us. Within that, the inventory days will be somewhere closer to about 100 days. The receivable days should be somewhere closer to 30. And the payable days will be about 20 days minus where the inventory days are. So that is where we believe we'll continue to operate in the mid to long term.
Lastly, on the FMEG business, so even though this was a great quarter for the FMEG business, but we are still not seeing it EBITDA positive. So what's your take on this?
So we are working on the FMEG business. As we've been guiding in the past few quarterly calls, there are a lot of different things that we are doing within that business. We have a strategic roadmap for us on how we want to change that business. We have identified these 4 areas where we have to do a lot of work. We are working on improving our reach. We are working on new product development. We are working on improving our brand positioning. And we are also working on influencer management. The goal going ahead for us will be to do a good job of execution on all these 4 identified areas. As far as the profitability is concerned, that will also gradually become better with time. Over there are 3 levers on which we are working on. Within the product categories that we have on the FMEG business, historically we've been focused more on fans and lights. But over the past year or so, we've started working more on the footage and switchgear segment, and both of them are such product segments wherein at an industry level, the competitive intensity is relatively lower, and hence the margin profile is better. So we are working on increasing the mix of those 2 product categories within the FMEG business. We've had some success over the past year where the contribution from those 2 product categories have increased up. We'll continue to work on that strategy, and that should result into improvement in margins as far as the FMEG is concerned. Within the larger product categories of fans and lights, again, we are working on the premiumization of our offerings. Through our new product development initiatives, we now have offerings across price points. Within both fans and lights, we have been able to improve the contribution from premium products, and that is where we are actually seeing improvement as far as the margin profile is concerned. And third, and again an important point, is the scale in the business. As you are well aware, within our FMEG business as well, we manufacture everything in-house. As of now, the utilization rates are quite low, but as the business scales up and utilization scales up, we'll have operating leverage, and that should again help on the margin front. So as far as the goals are concerned, in the near term, our first goal will be obviously to curtail the losses and become positive at an EBITDA level, and then gradually enter into profitability.
Okay, thank you. Thank you so much. All the best.
Thanks.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is, any update on the income tax issue?
So Sonali, as of now, there is no further update than what we had communicated in our previous investor call. Even as on the present date, we have not received any tax demand notice or any other order from the income tax authorities. Having said that, it goes without saying that we are fully committed and we cooperate with the income tax authorities as far as their procedure is concerned. Our priority still continues to remain transparent and adhere to all regulatory requirements. And as and when there is an update to be given, we will be very proactive and provide the same to the market as we have been doing in the past few months.
Understood. Helpful, Chirayu. Second question is again on the exports, because exports seems to be the main reason for the margin dilution this quarter. So we understood that there is an interim transition of the business model to a distributor-led model in the US. How many quarters do you think this impact can sustain?
So Sonali, it will still take us a bit of time as far as the geography that we are discussing is concerned. It will take us a few more quarters. It's a large geography and we'll have to have enough distribution in place. We'll need to have knowledge of the fast-moving SKUs, and hence it takes a bit more time to completely move to a different kind of a business model. But having said that, while that continues in the US, we continue to work on other geographies. Every quarter we keep on adding newer geographies where we can supply our inventory to, and that is where we'll continue to scale up the business or the international business from the other geographies. You're correct in your assessment that the larger decline in margins during this quarter has been because of the international business. What one also needs to, so while we had good sales happening in the other geographies, what has also happened is the freight costs have increased over the past few quarters, and hence when you compare this, the margin profile of international business in Q1 of this year versus Q1 of last year, you have that additional impact. So even in the international sales that we've done in this year, the margin profile is a bit weaker than what we had in the past year. So that is contributing a bit more as far as the margin suppression is concerned. But as far as the overall demand momentum is concerned, we believe that it's very strong, and that's from across all the geographies. Us being a very, very small player, we still have a lot of opportunity to do work over there and continue to grow. We'll keep on adding new geographies, diversify our risks over there, and keep on adding newer and approvals, and that is how we'll be able to continue to scale up the international business.
Understood. And our target of exports reaching 10% of sales is by when? F26.
Yes, so as part of the project lead, we target to reach 10% of contribution from international businesses for FY26.
Understood. And just one last question. Any change in your earlier CapEx guidance?
No, there is no change. As you would have seen, even in first quarter, we've done a capex of about 280 crores. So we are on track to do the capex on our guided range of 1,000 to 1,100 crores. We believe it should be towards the higher end of that range. But yeah, we are on track. We believe the demand momentum in the domestic cables and wires business is very strong, and will continue to be the case in the many years to come. We believe there is enough and more requirement for large players like us to add on capacity so as to be able to cater to all this increased demand that will be coming over the next few years. And that is why we continue to work on the capex guidance that we've given.
What's our current average capacity utilization in cables and wires?
So for the first quarter, it was somewhere between 70 to 75%.
Understood. Very helpful. Thank you, and all the best.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good afternoon. Chirayu, my first question is, my understanding for any specific project, cable and wire is like 4-5% of the total project cost. So what are these projects that
clearly audible? Can you please repeat?
I'm saying that, to my understanding, for any project, cable and wire is like less than 10% of the total project cost. So what are the kind of projects that we are taking where, cable and wire is a substantial proportion and it makes sense for us to take a good project?
Again, I wasn't able to hear it very clearly, but I believe you are asking that generally the cost of cables as the overall cost of the project is generally sub 10%, and what are the kind of projects that we are undertaking within the EPC business, wherein the cables are higher, right?
Yes.
Right. So within, as you mentioned, within the EPC segment, we are largely taking the RDSS order. The RDSS scheme is for revamping the power distribution infrastructure in geographies, and that is where the component of cable supply is high. So generally, you are correct. In normal infra projects, the component of cable supply is roughly in low single digits, somewhere between 3 to 4%. But in power transmission and distribution, the component of cable supply is higher, and those are the kind of projects we largely undertake within the EPC business.
Right. Okay. So this is where the cable is being redone. Like these are not new distribution lines being set up.
Yes. So it's as of now, it's kind of an upgradation of existing infrastructure. But what has been guided by the government, it might be in the future in the new RDSS scheme that they might take up post completion of this scheme. It might be also for new infra. Because, as you know, in India, the power infra has a requirement of because of all the investments that we believe in doing in the renewable space and the new infra which will be required over there. There might be such projects which come up in the future, but as of now, within the RDSS scheme, the larger outlay is for revamping of existing infra.
Right. Secondly, can you share the breakup of your cable and wire revenue this quarter between B2B and B2C, and what it was, let's say, for the whole of last year?
So cables versus wires, the mix within our segment was somewhere at between the cables would have been contributed closer to 75%, whereas wires would have contributed closer to 25%.
And what was the number for 24?
Again, similar, just a few bits lower. So again, as we mentioned, even in this quarter, the cables have outgrown wires, and that is where the mix has again gone in favor of cables. But largely, pretty much similar contribution from cables and wires in FY26.
Right. So just one housekeeping question. Between international and B2C, which is the higher margin business for us?
Yes, B2C. So within B2C, the wires business is the better margin business. So generally, when the commodity prices are stable, we make somewhere between 15 to 16% at EBITDA level on the wires business, whereas on domestic cables, we generally make between 9 to 11%. International business is again a much higher margin business. But within the B2C, as of now, it's the wires business which is of better margin. FMEG business is something that obviously in future we will have profitability coming in.
No, so exports is even higher than wire margin, though?
Yes, that is it.
Oh, okay. Thank you.
Thank you.
Thank you. The next question is from the line of Swati Junjunwala from JM Financial. Please go ahead.
Yeah, hi. Thanks for taking my question. I just wanted to understand within the FMEG segment, what are the focus regions that you are looking at in terms of expansion? And do we have any target as to what will the 2,900 retail FMEG dealers that we have, any expansion plan on that? And also, related to the FMEG business, could you also give me a broad understanding of the mix within the FMEG segment?
Sure, Swati. So within the FMEG business, as of now, we have pretty good stronghold on the western zone of the country, and that is where largely our distribution is based. But obviously, the idea is to improve it across the country. Those 2,900 dealers or distributors which are currently distributing our FMEG products, obviously the number should go up materially, and that is what we are working towards. This is something that will obviously play out in the near future, as and when we keep on tying up with newer distributors and dealers. If you look at the industry leaders, they have over 16,000 dealers and distributors. So there is a lot of work that is required to be done by us on the distribution expansion, and we are working on that. We have identified the kind of distributors that we want to work with across all the geographies, and the idea will be to improve our presence in all the geographies across the nation. As far as the mix is concerned, the fans and lights, both of them are the larger contributor within the FMEG segment, contributing somewhere between 50 to 55% of the FMEG top line. Switches and switch gears would contribute in high teens. Similar contribution will be from conduit pipes and fittings, and the other businesses are relatively smaller, contributing in single digits.
Understood. And just one more thing, this so wire and cable, which is currently 75-25, do you expect this to materially change over the next 2-3 years, or is it expected to stay within the 70%, given that there is significant real estate registrations that we are seeing in this country? So what's your view on that?
So Swati, as far as the company's intention is concerned, obviously we would want to improve the mix more towards wires because wires are better margin business. But ultimately the growth rate depends on what is the end, what kind of growth is being seen as far as the end demand and infrastructure or real estate demand is concerned. For wires, almost 70% of the demand comes from real estate, and that is where continuous growth in the real estate is important for wires growth. As far as cables is concerned, the demand is from across various infrastructure sectors as well as industrials. And over the past 2 to 3 years, we've seen a lot of investment happening within that space, and as a result, we've seen the cables outgrowing wires. But what we do believe is that we are now in that phase of real estate upcycle, wherein the demand for wires should start picking up. We've already seen a couple of quarters where we've seen the demand for wires improving than what we had witnessed over the past decade or so. And that is where we believe that if what we think will pan out, that is where the wires growth will also pick up, and that is where the mix might move more towards wires. So it will be difficult to say what that 75-25 will look like in next 3 or 4 years, but we do believe that mix should change more in favor of wires.
Sorry to interrupt, sir, but the current participant has been disconnected. We will move on to the next question. The next question is from the line of Nikunj Gala from Sundaram Asset Management. Please go ahead.
Yeah, good afternoon, everyone. Just continuing on that part, so in this quarter where you mentioned 10% volume growth in domestic business, how the growth rate would be bifurcated between cables and wires?
So Nikunj, cables has grown faster than wires, so it will be in double digits, while wires volume growth will be in single digits.
Sure. So in the last few quarters, like, we have seen wires, the growth rates are, pretty much lower than the cables. I understand, I take your point of real estate, but is there in the next, few quarters, what's the outlook there? Do you see the real estate demand, leading to a better volumes in wires?
So because that was what I was referring to. We do believe that there should be a pickup in the demand for wires over the course of next few quarters. And if that pans out, there should be an improvement in mix more towards wires going ahead. It will be very difficult to say whether it will be from next quarter or a couple of quarters from now. But if you take, let's say, next 4 quarters or next 8 quarters view, one should definitely see a pickup in demand for wires because of all the real estate projects which are now undergoing construction across the country.
Sure. And lastly, what would be our capacity utilization in cables versus capacity utilization in wires?
So utilization rates will be higher in cables. See, at the company level, we were operating between 70 to 75%. So cables will be at the higher end of that range, whereas wires will be at the lower end of this range.
Okay, sure. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Girish from Morgan Stanley. Please go ahead.
Yeah, hi gentlemen. Thank you for the opportunity. I'm sorry if I missed this, but a couple of questions. So my first question is to Inder Bhai. I think promoter family sold 2% stake at the fag end of June. Outlook-wise, all comments that are coming through from the business are very positive. I just wanted to understand, it's not a small sum because it's almost 2,000 crore. If you can just probably highlight or want to comment the use of funds and timing of the decision to sell the stake. That was first question.
Please, why don't you continue and share all your questions, and then we'll go one by one.
Yeah. The second one was this particular quarter exports was weak and it is explained. If you can just provide us some outlook for fiscal 25 because this number obviously is sub 6%. Can we expect for fiscal 25 this number to be between 6 to 6.5%? of overall revenues. And the third one is more, I saw there are a couple of changes that have happened on the committee on where it's become more independent. Any initial feedback from further strengthening the governance, etc., that have come through? If you'd like to share any of that update. Thank you.
Thank you. Thanks a lot. So I'll probably start in reverse order. We got listed around 5.5, 6 years back, and corporate governance is the center of whatever we do, and it's a journey, right? It's not a destination. So in our recent interactions, we realized that there are still better practices than what we were following. In the case of these two committees, which you have rightly pointed out, we had presence of chairman in those committees as members. And though these are perfectly, totally aligned with the legal requirement and totally compliant, we realize that if you pick up the large companies in the country, there are only limited instances which are available wherein the chairman of the company, who is an executive, is also a member of such committees. And we felt that a step in the right direction would be to not have executive directors in the committees like audit committee or NRC. And that is why board yesterday decided to reconstitute a committee. Both of these committees now have only independent directors, and that is why that change was done. And we believe that's a step in the right direction, and we will continue to make efforts to further improve on corporate governance practices wherever we believe there is scope for improvement. Having said that, I would like to especially call out the previous composition was exactly in line with the legal requirement, so it was any request compliant. Now, moving to the first part of the question, though it is for the shareholders to answer, and it's a shareholder decision, since I'm privy to the decision-making process, I'll probably share that. Would be more comfortable having those conversations and not answering those conversations in the formal setup. But since you have raised it in the formal setup, I will probably attend that question. So the promoters raised the money as part of the IPO in 2019, and since then there was no material transaction. It's a fairly large family, as you know, Inderbai, along with three brothers, founded this company almost 50, 60 years back, and whatever money was earned by the company was deployed into the business. And over the period, now the second generation is also available, and they also want to do several other things. So to meet the personal requirements from the second generation of the people who are not involved in the company, they decided to raise some money. Though it, on the face of it, looks like a sizable amount, but it's not necessarily a sizable amount when you start thinking about the number of individuals who are involved. And they have their personal needs. They want to have their, better houses or properties outside of what they already have. Few of them would like to explore investments outside of what they have. So it's only for personal consumption. It is not for any other business venture or otherwise. And I don't expect this to be a regular feature. This was done practically, if I'm not wrong, first time or second time since the time we got listed. I would tend to believe this is going to be once in a while type transactions, not necessarily a regular transactions. And on the second part on exports, I'll probably defer it to Chirayu, and he will take a question.
So, Girish, as I mentioned in my reply to Sonali, the last quarter was a bit weak because of softness in one of our larger geographies. And again, something which I mentioned to another participant was that one needs to take an yearly view rather than a quarterly view as far as this business is concerned. We believe if you look at our numbers going ahead in every quarter, you see an improvement, and that is where the contribution from international business to the overall company's top line will also see an improvement compared to what we have been able to register in the first quarter of this year.
Thank you and all the best.
Thank you, Girish.
Thank you. The next question is from the line of Niresh Jain from PNB Paribas. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. Sir, firstly, I just want to understand, like, what is leading to this high interest cost in 1Q, like, and especially, like, I understand this might be on the back of higher channel financing, but my understanding is that we are already close to 70-75% of channel financing. So in that context, why are we seeing such a sharp jump in the finance cost as compared to our top line growth? And secondly, my question is more on the margin front again. I'm sorry if this has already been answered, but I just want to better understand, like, the major reasons that had been highlighted for a margin contraction is on the higher contribution from EPC business as well as the decline in exports. But these two issues seems likely to likely to be there at least in the near term for next 2 to 3 quarters. I mean, your EPC business is likely to be likely to contribute roughly high single digit versus what it used to be 2 to 4% in last 2 to 3 years, as well as on the export side that distribution model change is yet to stabilize. So what is leading to our optimism on these margin expansions from here on versus what we saw in the first quarter? That's all. These were my questions. Thank you.
Thank you, Niransh. On your first question on interest costs, the interest costs are linked to our procurement, not to channel financing. And channel financing, it's a non-recourse facility, and the facility is between the distributor and the bank. We are not liable to pay any interest on that. As far as the interest financing cost is concerned, it's because the acceptances have been going up. So when we procure our raw material, we would employ LCs over there, and that is where which is an interest-bearing facility. If you look at the acceptances number, compare it past Q1 versus this Q1, you would see that there has been a material change, and accordingly there has been a rise in the financing cost. On the second part on the margin of the company, you are correct on your two assumptions, where the EPC business will relatively contribute higher than what it has done in the past. But there are two other things to be considered as far as the international business and the domestic business is concerned. Within quarter one, since the channel business was affected because of higher commodity prices, and that is where the contribution from that business went down. That had a material impact as far as the margin profile of that segment is concerned. Since the commodity prices are now relatively stable, we believe that this one-off instance which happened in the past quarter shouldn't be the case in the quarters to come by, and that should result into better or improvement in the margin profile. On the international piece, again, as I had mentioned, there has been an increase in freight cost across the geographies. Again, this is something which is temporary. It should come down in the near future. As and when that happens, that should result into an improvement in margin profile. So these are both of this is something which will result into improvement in margin profile, and gives us the confidence that we should be able to show an improvement in the quarters to come.
Sure, sir. Thank you for the opportunity. Yeah.
Thanks so much.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would now like to hand the conference over to Mr. Gandharv Tongia for closing comments.
Thank you so much for your time. We look forward to your continued support. In case if there are any unanswered questions, please feel free to reach out to our group email ID, investor.relations@polycab.com. Thank you and take care.
On behalf of Polycab India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.